Hello everybody, welcome to join our webinar How to Invest in Growth Stock. And we are very proud to kickstart this first webinar series with Kenanga Investment Bank. Okay, and this webinar is brought to you by Kenanga Investment Bank and managed by LifeChamp. All right, and today we have an authority, an expert who will talk to you about how to invest in growth stock, and he's none other than PC Wong.
Hi, a very good evening to all the listeners.
Thank you for joining us today. And today we have an overwhelming response, and many of you have already logged in. So if you can hear us in the webinar and see us on the webcam, please click the raise the hand button. And let us see if you can hear us, see us on the webcam. Please click raise the hand button. All right, thank you so much for your hands. You may put down your hands right now. Okay, so the audio works fine, webcam also works fine. Now, growth investing is always a very challenging topic, because oftentimes growth stock is always at a high valuation, right?
Yes, yes.
You may not know whether you buy it. Are
Yes.
you going in at a high, or is it a trap?
Yeah, I think mainly because a lot of investors, when they see a certain stock that has tremendous growth potential, they will actually buy into the stock in expectation of the future earnings, not so much of its current earnings. So for example, growth stocks that have patents or certain technology advantage, you will see that people would immediately move into that stock in preparation for future movement. That's why sometimes growth stocks, they have higher PEs ratio than other normal companies. So, but it's an exciting thing, you know, to participate in that growth.
Yeah, excellent. That's why Kenanga Investment Bank thought of introducing a series of webinars to address some of the biggest, most important topics that investors are interested in, like growth investing or portfolio management or valuation method. So this is what we'll be looking at in this year, where we kickstart this webinar series with Kenanga Investment Bank. So, all right, let me go to the most important slide, which is disclaimer. All right, so whatever we share in this webinar is only on educational purpose. So in no way that we give any buy or sell signal on any of the case studies that we, the speaker or us discuss or presented in this webinar. So if you decide to do it, to buy or sell any stock, you do it at your own risk. Is that okay? Okay, cool. So next is, let me introduce the speaker next to me today, and his name is PC Wong. He graduated from NUS in 1989, and he has more than 27 years of working experience with several publicly listed and multinational companies. And he's a full-time investor, author, and trainer, and have been investing in Bursa and international markets since 1995. So it's like more than about 24 years. Okay, and he's also two published authors of Invest in Foreign Shares, which reached Popular's top 10 non-fiction bestseller in August 2014, and also this book called Invest in REITs. He's also speak for Bursa for a good 4 years now, I believe, and also appear on several media and columnist in Shane Choo finance segment. And this is some of his media exposure and also his book signing. So yeah, PC, what are you going to share with us today?
Well, we are going to talk about some technology stock, but as we go further along, growth stocks, a lot of people mistakenly that it must be technology related, not necessary. Sometimes it comes in the form of other types of industry, but that we'll share with you later on. But let's talk about what we want to talk about.
So today the session will be 60 minutes on content, and then we'll open for 15 minutes for Q&A. So it's going to be 1 hour and 15 minutes.
Okay, so how to invest in growth stocks? Of course, we'll go through the topics, understanding the characteristics of growth stocks, learn the risks and rewards of investing in growth stocks, learn how to identify growth stocks, learn the strategies to invest in growth stocks, and what industry will be the next growth miracle. I think this will be of particular interest.
So what exactly are growth stocks, PC?
So growth stocks are a share of a company whose earnings are expected to grow at an above average rate relative to the market. So that means that sometimes the market within that year may move within a 5 to 10% range, but then the growth stock could actually move much higher, around 20 to 30%.
Wow.
Yeah.
How about a company where the revenue keep growing but the earning do not grow? Do you consider this as a growth stock?
Yes, sometimes it can happen because sometimes the company could be in the early stage, and a lot of it, the earnings may not reflect that kind of potential that the company would have. Okay, so normally it doesn't pay a dividend, okay, as the company would prefer to invest retained earnings in capital projects. So which means even as the company earns money, the money would be plowed back into improving its ecosystem where technology is concerned, or in terms of biotechnology, it will be plowed back into furthering the research and development of a particular product. Yeah, so growth investors normally choose stocks based on the potential for capital gains, not a dividend income, so they can be risky in that sense.
Yeah, because many growth companies want to retain their profit so that they can reinvest their profit into building more plants, buying more lands, to increase more production lines,
yes,
so they can make more profit in the future.
Yes, so that's why, you know, if you are a investor that focus on dividend only, growth stock may not be the cup of tea that you're looking for. But if you are holding a portfolio of companies, sometimes it is worthwhile to have some steady income streamers, okay, companies that give you steady dividend, and a part of your portfolio, you know, is committed towards growth potential. Then you will not just rely on a single type of potential in the industry sector. So this is what I do with my own portfolio as well. I have some that are more growth intensive and some that are more steady income streamers, for example, REITs. Yeah.
All right.
So characteristics of a growth stock. Now, consistent growth in revenue and profit abide during recessionary or seasonal cycles, which may see both revenue and net profit growth being impacted negatively. And this is something that most people would see in a recessionary cycle, okay, or when there are certain external factors, for example, like the current US-China trade war, you know, that might impact, you know, some companies in particular, because suddenly that demand for a certain product drops tremendously. So another characteristic of it is that it's outperformance versus peers in the industry. So in an industry, sometimes there could be a new entrant into that particular industry, but they change the entire system of operating within that industry. Now that new company could be a growth stock, even though, you know, some of the peers in the industry have seen their valuation reaching a certain fair value or overvalue, okay, and there's no longer any growth potential. So sometimes new entrants in an industry can actually ignite, you know, outperformance versus other peers, and then continue growth in the company's equity to deliver growth in share price. So very importantly, when you invest in a growth company, you not only look at revenue and profit growth, but you also want to see that there's equity growth, because sometimes companies would want to they incur a lot of liabilities, okay, in order to spur the growth. And what happens is that because liability needs to set off against the asset to deliver the equity. So if liabilities becomes too huge, then the equity could actually shrink
in comparison. I mean,
yes. So that's why it's very important for you to, you know, a company must have demonstrated that they help to grow the equity value, because you want to see the share price appreciate in terms of equity, and also in terms of revenue and net profit growth. The other thing is valuation may exhibit higher PE ratio or share price over net asset value per share, as investors may invest for the future, instead of relying on current earnings and equity level. So that is why sometimes, you know, when we read certain articles or certain books, people might say, you know, preferably you have a PE ratio of 10 to 15 to, you know, to really make it worthwhile to invest in a particular stock. But I can share with you that the valuation of growth stock normally is much higher than that standard requirement to be within the 10 to 15 range, because when a company has certain market advantage or certain edge in the particular industry, people wouldn't look at what is the P ratio. They would know what is the future potential that is, and they will pile in their investment. So in that sense, the PE ratio will be much higher. And then there must be an immense potential to grow the market share and in the fastest growing market. So when you want to look for a growth stock, okay, try not to look into an industry that is very mature. Okay, for example, you know, like in the plantation, you know, plantation business, if a new entrant move into the plantation business, it may not be a fastest growing market anymore.
Already saturated.
Yes, it's already saturated. So assuming, but if let's say there's one high-tech company that is using the waste from all the processing from the oil palm, and then they generate energy, then that could be a growth potential, because it's something that is, you know, normally the waste is just it's not properly managed, but this one able to convert it into energy, biomass, then it may be a growth potential. Okay, so that's why you need to look at what type of industry it is.
So not necessarily in tech industry, but growth stocks can also appear in other emerging industry as well.
Yes.
Yeah, so long that the company has a proprietary technology or IP that can consistently bring in revenue, increasingly more revenue, increasingly more earnings, then it could exhibit the characteristic of a growth stock. But so most of the times, this growth stock will fetch at a higher valuation because many investors want to position themselves first for the future.
Yes.
So would you still invest in growth stock even though it is a high PE?
I would, if let's say the conditions that exist in the current environment permits it. Okay, for example, like right now we know that there's a global slowdown, so I wouldn't advise people to rush in, you know, after this webinar and start looking for growth stocks, because growth stocks, the only thing that can set them back is mainly something that is beyond their control, which is the overall global economy, you know, because global economy slowdown would spread across all industry sector, and for growth that could be quite badly hit as well. Let's look at example South Korea. Okay, South Korea, you know, their growth sector is the semiconductor, but because of the global economic slowdown, consumption of electronics actually start to fall off. Okay, auto vehicles also start to fall off. Okay, then semiconductor sales in the market has fallen. So South Korea export actually seeing a decline of 21%. So that affects those kinds of technology stocks in South Korea. So that's why you need to be very careful, not because it's growth, you disregard everything, okay, and not take into consideration of impact from external factor. Yeah, because impact from external factor can be very overbearing. Okay, the other thing that you should look out for, you must have a good management team with clear and committed vision for the company. Okay, so in that sense, that management team must have very clear and concise what they want to be and how they want to reach there. So sometimes we have a management vision, mission statement that is, you know, can be very outrageous, you know, want to build a global empire, you know, and all those things, but there's not enough substance in it. So that's why, okay, don't be easily sweet talked by the management's mission statement, but look at the concrete plans that the management will announce now and then about their stage to stage progress. For example, they have secured this particular contract, okay, to supply XYZ, okay, to this to a market worth how much, or they have secure a patent, okay, covering a global patent, okay. So, or they secure a master licensing covering the entire region for a period of 5 years. Then these are the things that would deliver the kind of growth. Okay, what the management has done.
Management is very important because they're the driver and the leader, the captain of the ship of the company.
Especially if that company is a tech company. Look at the credentials of the management. Okay, they must, the credentials of the management, they must be, for example, if let's say one particular board member, okay, they have been in startups, from incubating stage, being in an incubator, and have relations with venture capitalists, those kind of things. Those are the things that you want to look at, so that you know that this company, they have a team that is well versed in how to secure finance, okay, well versed in how to build a company, and also, especially in technology, they also have the relevant professional qualifications, okay.
Please, you want to sit closer so the webcams can see you better.
So let's talk about consistent growth. How do you determine? Now, need to study a company's historical financials around 3 to 5 years. Okay, that would be enough. Actually, with particular attention paid to the last 3 years.
So now your focus is 3 to 5 years.
Yes.
Not 10 years now.
Not 10 years, because right now we are moving in an age where technology changes very fast. So sometimes those things that work in the last 5 years may not work
in the recent 1-2 years.
In the recent 1-2 years, because of the advent of new technology, new processing. Okay, now you'll be surprised, for example, the so-called 3D printer. I read recently, just today, they have used a 3D printer to print a boat. Okay, last time we read that in Europe they use a 3D printer to print a house. So these are the things that are changing. And just 2 years ago, 3D printer is just printing small items, but in this year alone, it has changed into printing a boat and then printing a house. So that's why the advancement of technology is such that it will change the sphere of the industry very, very quickly, right? So must demonstrate growth in the following areas if you are looking for a growth company in terms of revenue, net profit, and equity. Now, all the above factors will influence the share price, because the dividend may not be there yet. Okay, so you cannot look at dividend yield as influencing the share price. So that's why you need to look at revenue, net profit, and equity.
In fact, maybe the time where they declare dividend, people would not consider that as growth stock, because they are not growing.
By the time they declare dividend, the company could be moving in already huge multiples from their initial starting stage. And I will share with you some of the local companies. Okay, so this is Vitrox Corporation Berhad. So you can see that their revenue from 2014 was 169 million, but they have moved in 2018 to 394 million. So you can see that tremendous growth. Okay, and profit before tax, okay, from 50 million, they have moved up to 130 million in 2018. And then profit after tax from 49 million to 105 million. So it's almost double over the last 5 years. Basic earning per share from 10.56 cents to 22.43. Now, all these have been adjusted against all the rights issue, bonus issue, etc. Yeah. So total equity, you can see that they move up quite tremendously from 174 million to 413 million. Return on equity has been very consistent around the 20+ range. So if let's say you're looking for a growth stock, and if the revenue may grow, okay, quite strongly, double digit, but then if the return of equity is very, very low, let's say it's less than 10%, then is that really a growth company? Now, these are the things that you have to know. Why is it that revenue growth is high, but then equity growth is low? Now, one of the things could be because they use a lot of debt to spur the growth expansion in revenue. Now, then you need to go back to the liabilities and see how huge is their commitment in that. So these are the things that you can check back against. Yeah.
How about if you look at this example,
Yeah.
like the revenue is on the increase, but the ROE decline for a little bit.
Actually,
you know,
I think as long I do not want to look at just equity to be consistently growing, okay? But then if the return on equity is so-called acceptable, okay, then I am quite fine with that.
So it doesn't matter whether it's not that important if the ROE keep increasing.
Yeah,
in your opinion,
yeah,
just that so long that the profit after tax increases, because sometimes maybe the management cannot really manage the ROE so well. Even the ROE is a reflection of how competent a management is in using the shareholders' equity.
Yeah, so that's why the what is important, you look at the total equity. Okay, that's growth there.
Yeah, must grow because all business, the ultimate goal is the increase.
So in terms of return on equity, as long as it's consistent within a certain range, it's just like let's say your debt to equity ratio. You know, sometimes it may go up slightly, sometimes it may go down. Of course, you won't hope that debt to equity will be consistently low, because if let's say it's consistently low, then some people might question the management do not know how to manage money, like securing debt to expand the business diligently. You know, so that's why it's not always that you want to see an upswing in the figures when it comes to certain percentages, except that percentages have been showing consistency. Okay. So this is the 5-year performance chart. You can see, you know, that the basic earning per share has gone up versus the you know, over the last 5 years in terms of revenue, and then profit before tax and total equity. So how did the revenue, net profit, and equity perform versus peers within the same industry? So look for signs of positive growth that is above the market norm. So I'm comparing Vitrox and Unisem because both of them are in the semiconductor business. Okay. Now you look at over the 5 years, revenue of Vitrox gained 132%, Unisem only 23.2%. Net profit of 114% gain versus 41.5%. EPS 112% versus 29.4%. Equity is 136% versus 39%. And ROE is 25% versus 6%. So that by itself already compared within the same industry goes to show which company has greater growth potential. Okay, and Vitrox has demonstrated through that consistency throughout the 5 years. Okay, so Unisem in that regard, okay, is a laggard. Okay, they are not able to meet that kind of growth, and therefore I wouldn't term Unisem as a growth company. More like, you know, it may have reached a certain maturity stage, because over the past 5 years, if you look at it, revenue over past 5 years only gained 23%. It's like over the 5 years, it's only gained like annually 4%. You know, normally when companies growth, you know, start stagnating or in low single digit, it means that they have reached a certain maturity or brand recognition in the market, unless they have some new inputs that will actually help to push the share price higher through business expansion or acquisition. Then, you know, further growth, tremendous growth, double-digit growth will unlikely to be happening. So valuation is based on potential in future earnings, even if there may be no earnings in the recent financial year or years. In the absence of earnings, it is important to track what the company has done thus far to capture market share and what its guidance moving forward.
So you mean that even if the company is not making profit, it can still be considered a growth stock?
It can consider a growth stock, provided, you know, okay, the company has certain plans to how to secure the market, because it's always based on future earnings, right? Now, of course, On the other hand, if there's no strong earnings, then the risk will be higher. Okay, because whatever company you need to have to earn money to plow back into to the company to gain expansion, R&D, and so forth. So if let's say the company has no earnings, okay, now in Malaysia, I think we seldom see it, but in overseas, you have a lot of companies that actually have zero earnings. And these are the tremendously huge growth potential. Like biotech companies in overseas, what they have is to secure the FDA approval of, let's say, a cancer drug. So what the company in the US would do, they would raise money by listing, and then they will have first phase, second phase, and third phase clinical trials. So the first phase would be the final one where we will know they will secure FDA approval or not. So during that stage, they have no earnings. So what do? They have dilution. So in that sense, at the early beginning of growth stock, there can be a lot of volatility because the moment they secure funding, often comes with dilution. And even more right now, companies, they are very afraid of debt. So that's why they prefer not to commit that, but they continue to issue shares. So that's why a company in the biotech sector in the US, for example, the share price could be starting off with $4 because they have a very novel idea how to cure a particular type of cancer. Then when it's listed, wow, the share price can move up to $5 or $6 or even $10. But then after they burn the first tranche of money, then they issue a second tranche of funding with share placement, then the share price will gradually drop. So this is very common in the US, okay, and also in Australia, I come across, okay, companies that start out with zero earnings. But once they secure that FDA approval, the multiples that comes with it is totally fantastic, because high risk, high gain, okay? So that's what we can see. But I think in Malaysia, I think we see less of this. There could be profit, okay, but then that profit may continue to grow bigger, or sometimes they start even at a loss, although there's a revenue. So if let's say there's a revenue, but there's a loss, then you need to find out why. For example, revenue gained tremendously, but then there's still a loss. So you have to see where the money move, okay? If let's say the money is used to reinvest in R&D, okay, the money is used for acquisition, then that could be a positive thing. Not necessarily everything must be positive, okay, but you must know what the management is doing, okay? So that's why it is important to keep track of the company, what the company has done to capture the market share, and what it is guidance moving forward. So the balance sheet itself could be a base to value the company in the form of total net assets or total equity. So you can use the balance sheet to as a reference, okay? If let's say there is equity burn, declining equity, okay, then you need to be much more careful because equity can only decline, for example, okay, decline in net profit or increase in liabilities. So these are the things that you need to be aware of. The other thing is definitely they may exhibit PE ratio that is very high or share price over net asset value per share due to investors' pursuit of future potential. This has been always the trend in terms of growth company valuation. For example, here we trust have a PE of 35.95 and then share price over net asset value per share of 8.56 times. While Unisem PE is 25.27 and share price over net asset value per share is 1.4. So that goes to tell you that one is like investors are no longer keen in Unisem, okay, because of its nature that is, its revenue, net profit have been rather stagnant. There's no one to, it's like people think that Unisem may not have that kind of growth potential anymore. So there's no investor chasing after that stock, and therefore the share price over its net asset value per share is reducing. Now the other thing is that it could be that its net asset value per share has not shown tremendous appreciation that people are willing to pay that price as well. So just now we see that it's equity growth is also very small versus REIT stocks. Yeah.
Is there, when it comes to valuation, is there a limit as of, let's say for a case of Amazon, at one time the PE go up to like 200 over. Is there a limit where you feel that when the PE is above a certain range, you feel that it is unsafe to invest in a growth stock?
Now, when there is any type of PE that's very huge, it is always very important for you to reflect back as to its valuation condition versus the peers. So you check back against the peers. So for example, if Amazon is very high, then you look at what is Alibaba.
Yeah.
Okay, then you look at what is JD.com. Okay, so when you have this kind of companies, yeah, that is in the e-commerce or online business type of companies, when you weigh it against all of those, then who has the lowest PE, but also good revenue and net profit growth? Okay, you'll be then doing a comparison. Okay, now at the end of the day, you might want to select, if let's say you have done comparison, you might want to select Amazon still, even though its PE is high, because you read a lot of those analyst report that says that buy, you know. So actually, at the end of the day, it's whether you want to rely on your own analysis, okay, where you do a comparison, or you want to rely on the analyst. Okay, if you rely on the analyst, there's no right or wrong. It's just that you place your faith in them. But if let's say you place your faith in your own methodology in analyzing, then you might opt for maybe Alibaba or JD.com. I don't know. Okay, it depends on the status of your analysis. Yeah.
I see. Okay.
So potential to grow the market share. Now, the ability of the company to capture and grow the market share is determined by the following: possession of cutting-edge technology, okay, possession of patent or master license covering a region, and the ability to transform work process to improve efficiency by leaps and bounds. Okay, these are we are really seeing after I share with you some examples. Yeah, ability to change consumer perception and behavior. For example, Amazon, you know, it has changed the consumer behavior from going to the stores to buy things to going online. In fact, Amazon right now is being blamed for all the misery that's causing across the North America retail outlets. Yeah. Okay, Toys R Us is in bankruptcy. Okay, Under Armour, you know, they are closing stores. You know, in fact, the number of retail store closures in 2019 year to date is already more than the entire year of 2018.
Wow.
Okay, and that itself put a risk on commercial real estate, especially those in the shopping malls that are REITs. So that's why, you know, this change of behavior can really transform, okay, a lot of businesses that will be affected. So in that sense, okay, it could be a good thing for those people who bought, let's say Amazon, but a bad thing for those people who hold, you know, shares of Toys R Us, you know, like shares and all those. They are cutting. They are actually cutting stores, and there are so many bankruptcies right now of retail outlets in the US. Yeah, so good for Amazon, but bad for the rest.
Yeah, because in brick and mortar, you need to think twice.
Yes. But at least I think when it comes to food, I think people would still want to go to a restaurant rather than wait for, you know,
call delivery.
Those delivery, you know. And there's a recent report that those people, you know, that Uber food delivery in US, customers are complaining that how come the portion is much less that they order. Eventually, they found out, did a survey among all those people who delivered. They say that it smells so good they cannot control their urge, so they eat some of the food.
Serious?
Yes, this was a report out. Okay. So this kind of thing can happen. Okay, I hope people don't stop ordering from Grab food. Yeah. Okay, but you know, it happened in the US. Okay. So management vision and commitment, as there may be no earnings in the recent financial year or for the next few years. So that's why the management need to hold the shareholders' interest in that stock. Okay. If let's say the management, you know, is just hot but then cold the next, then that stock is not a growth stock, because there's no staying power. There's no long-term perspective of what to achieve. Yeah. So what are the risks? Now, when the company is not yet able to deliver earnings despite growth potential, then that is definitely a risk, because this is what we call the cash burn rate, especially in terms of new technology, okay, or new or in terms of biotech, the research into a new drug. The cash burn can be very, very high, even though there could be some revenue, but earnings are consistently zero or negative in terms of loss keep on mounting. Then despite revenue growth but heavy loss, then it may have signs of growth, but then it is still a company that's losing money. Now, one good example is Tesla. Tesla, share price is fantastic, but then they are burning billions of dollars over the years. That's only one particular quarter that they generated profit, but throughout the whole year, every year they lose money. So is that a growth stock? So some people analysts will say buy. For me, I wouldn't buy Tesla, because Tesla has been in the market for so long and yet they can't generate any net profit. Then that is something very wrong. Okay, and normally, when you buy a growth stock, it's very important for you to keep track of the company's quarterly earnings. That is telling you things, because the management will often give their own perspective of what they want, what is happening, and where they want, and what they want to do to push the company forward. Okay, so these are the risks. Okay, when long term you invest is still registering a growth, then that company is most likely not going to be very enduring over the next few years. So when cash burn continues at an alarming rate, okay, growth in losses outpaces revenue growth. Okay, for example, the most recent one, WeWork. So apparently WeWork cannot work. Okay, so what happened is that WeWork, their market value from 47 billion now shot down to about 10 billion, and the chairman has already, the chairman still remains, but he's no longer the CEO. Okay, but it's actually a Ponzi scheme. Okay, whereby eventually they found out that like SoftBank keeps on bidding up the value of the company. For example, like this first tranche of financing of the number of shares is worth this much. Then the next financing is also by SoftBank, but then higher value. So then they get other people to invest. So by pushing up that value, so eventually, WeWork revenue gain, very huge percentage, but the net losses is even faster paced than the revenue growth. This is when it cannot work anymore. Yeah.
So how do you take a balance between the earnings? Because just now you mentioned that even if there's no earning growth, it's okay, because so long that they can have a bigger market share. So you also look at the other operating statistics, like in terms of the market.
Yes. That's why looking how they have captured the market in terms of sales growth and all those, but don't be mistaken that all sales growth, okay, is definitely a buy. You need to check that. One, if let's say there's no earnings, there's always a loss. Is the loss narrowing? Okay, I would be interested to know that. If let's say, even if there's a loss, then the next thing you look, is the cash flow from operating activities turning more positive? So you have a few things to check against. Okay, once you have reached, once you have seen that, okay, even though the earnings are not there, but the losses are actually reducing, then that is a good sign. Okay, or when the operating cash flow, from negative is showing signs of positive month over month, I mean quarter over quarter, then that is also a good indicator. But if let's say the net loss is widening, then it's something that you not want to go into. So that's why before you invest in a growth company, you have to look at these financials. Okay, if let's say that is the net losses is mounting even as revenue is increasing, then I think it's not worthwhile your time or your money to invest in this company currently, until such time when the company has turned around. Then that is when you want to pay attention. Okay, so some of us we may have in our minds certain stocks that we already we think that we are very interested in. Look at those kind of metrics. Then that would actually save you from making a wrong decision in investing into a growth stock. Okay, so then of course when competitors enter the lucrative market and do it better and more efficiently, then the advantage of being a leader in the market quickly diminishes. I think one of the most famous example that I can give is Groupon. So when Groupon was listed, the share price went up. But subsequently, everyone can duplicate a coupon. They can always come up with the online coupon, and then you get discount, just network with all the eateries and restaurants. Then it becomes something that everyone can do. Okay, and that is when Groupon actually see its share price, keep on falling. Now another of a SoftBank favorite, Uber. Okay, they put in a lot of money into Uber, and then you move up, then suddenly you have Lyft, and then suddenly everyone has this ride hailing. Okay, in China they have Didi. Okay, and then Southeast Asia we have Grab. Grab becomes so huge, that Uber cannot compete. Then they bought over Uber's share of the market. Okay, so that's when it's nothing very it's not a patent or cutting edge, because it's something that can be very easily duplicated. Then that market share would be quickly eliminated if someone can do it better. Okay, so for example, Grab now has ride hailing. Okay, and then you have Grab Food. But in China, for example, this Meituan is actually food delivery. Okay, but Meituan did it in such a way that it is a combination of food delivery with combining TripAdvisor type. They have listing of restaurants with people comments and star rating.
Yeah.
Okay, and then they have also similar like Groupon. You can actually download vouchers. So Meituan is a combination of TripAdvisor, Uber, Grab Food, and then those kind of catalog listing. And on top of that, they came out with a Michelin type of rating called the Black Pearl. So that Black Pearl is becoming people's favorite to download, which are the restaurants that are good, to visit and so on. So they create a culture that is totally different. Now, then that is when they push aside all the other competitors already, because and Meituan actually see their profit grow. Sorry, not profit. Their revenue grow by strong double digit. I think almost triple digit. I think 96% or so, something like that. Okay, so that is when either you come in that is so big that you push away all the smaller fries. Okay, and that could happen in the tech sector. And for example, talk about handphone. During the early 2000s, that's only what we call the four heavenly king: Samsung, Nokia, Sony Ericsson, and Motorola. So every time in the shopping mall you hear the phone ring, it's a Nokia. Okay, because it's so common. Okay, so Motorola, Cantonese we say mo tat lo lah. It's gone. Okay, that company is gone. So right now the only staying one is Samsung. Sony Ericsson sold its share to Sony, but Sony is also not going anywhere. So much so, that Apple sneak in the right time and push away Nokia's share. So right now the top 5 phone distributor or phone brand in the market, Samsung is number 1. Number 2 is a fight between Huawei and Apple.
Now it's Huawei.
Yeah. Number 4 is Xiaomi. Number 5 is Oppo. So out of the 5 brands, 3 are Chinese brands. So the Chinese brands have sneaked into the market and then obliterate the rest.
Yeah.
Okay. So anything beyond 5, there's no rating. It's called the others. And Sony Ericsson and Sony is in the others. Okay.
The phone industry is so competitive that the new entrance of player and there's elimination of player.
Yeah. So then no one's expected Apple suddenly to sneak in with their smartphone. Okay. So that's how things can actually shift in the in a growth sector. So what are the rewards? Of course, first mover advantage if the company possesses new technology, patent, or owns a master license. In the early years of growth could be challenging, but as it gains traction, its appeal will gain support among investors, and that's very true. Okay, for example, at one time Apple was dying, then Apple suddenly discovered the Mac, and then the Mac changed. And then subsequently we have iPhone, iPod, everything that is I suddenly becomes very trendy. So that can change the company's to its advantage. Okay, going back to, let's say, Vitrox. Vitrox also came out of nowhere. Okay, and then they built up the industry, and right now there are products in terms of equipment for semiconductor testing and all those. They have covered a huge part of the globe.
They're definitely world class.
Yeah, they're world class. It's like no one expected a company to come in. When Vitrox was first starting, it's like it never gained so much of the investors' attention until they start showing tremendous growth, and that's why the share price actually moved very high. The last time they have a bonus issue, the share price from 10 dropped down to 5. Okay, then now it's back to 8. So that goes to show a company can really keep on pushing itself, then it matters a lot to the investors, and these are the signs that we want to see. Okay, so the other thing is further growth and rapid expansion could elevate the company to key benchmark, increasing the shares liquidity and investability, delivering both dividend and share price gain. So sometimes, when they first started off, they could be in the smaller exchange, okay, the startup type of exchange, and then they leapfrog into the main board. Okay, then that could even see more investment moving in, because suddenly that company has become investment grade. Okay, and this we can see in companies all over the world. Okay, just to share with you some growth potential here. When the dot-com bubble burst, Google is trading at, I think, less than $10. Amazon, a few dollars. Even Hong Kong, Tencent. Tencent, when it first started, it is trading at only 10 Hong Kong dollars. Right now, Tencent is 300 over Hong Kong dollars. Amazon, no need to say, it's 1,000 already. Okay, Google also around there. Okay, another company that has shown, even though it's in a mature market, but still see tremendous growth, especially Microsoft.
No, it's $1 trillion company.
Yeah, they keep on. It's all they have is just the software, which is their anchor product. Of course, they have their games and all those, but their core product, keep on generating growth because population keep on increasing, the usage of its software continue to grow. You see, so that's why it doesn't mean a growth company could be, after 5 or 10 years is no longer there. But some of these companies, they have tremendous staying power. So this is how Vitrox fared. You can see that since its inception in 2005, Vitrox share price has gained 44.6 times, or 4,460%.
It's incredible.
Yeah, it's just 14 years. So sometimes, that's an average of 318% per year. Okay, it's like, where can you find a company that deliver on an average? But of course, it's not in this year that they deliver 300 over, but over the longer term, as its share price appreciate, business continue to grow. It may still give you triple digit. Maybe it may not go back to 318, but then maybe the growth may slow a bit to 100 plus or 200, but then it's still a very good percentage of gain. So the thing is, why sometimes I see Malaysians in particular, why when we show this kind of chart, they seem very surprised, and then they would tell themselves, but I didn't see this happening in my Vitrox. Now, one of the things that I realized that a lot of Malaysian investors do is whenever there's bonus share. So whenever there's bonus share, because it's bonus, it's free, they want to sell first. So that bonus share is sold to get the money back in. But then this is a reflection of, if you have your bonus share, you still keep it, so that as the company grow, they issue rights issue, then you can also get more extra from your bonus. So you keep on accumulating the bonus, then over a longer term, it makes sense that it can grow so much. But if you are the type that whenever you have bonus, you sell it first, then you get the cash, you already spend it, but that company price fall, then you will not see that kind of gain over the longer term, because every time you have bonus, you sell first. This is based on accumulation of the because this is adjusted through all the bonus issues, right issues, and so forth. So that is when you see tremendous capital growth over the long term. So if you have a company that moment you get bonus issue, you sell it off, then of course you will never realize a much better gain over the longer term.
So it's worthwhile to hold on to the growth stock.
Yes,
yeah. So long
provided
earnings,
yes, that is why you need to monitor the quarterly earnings.
So long earnings keep growing, so pay attention to the quarterly results.
Yeah, you pay attention to quarterly. If everything is growing, then why you want to sell? Even if they issue the bonus, the moment that the share price drop because of bonus, I may want to accumulate some more.
Yeah. So in the VTRA example, if you have bought in 2012 and you sold in 2015 because of some profit, you double the capital. After that, in 2018, 2019, wow, you saw through the roof.
Yeah, because growth stock is sometimes the take-off will be much later years, but the initial stage may be a bit more challenging. But as long as you have a focused management and there's continuous growth, although that moment, it may be averaging about 20–30% per year. Before certain lift off occur, then you may see a huge jump of 50–60% in the next few years. Then that share price can really take off. Okay, so growth stocks and investment strategies. Now understand the company and what it does. That's very important. Okay, will the company be able to change a process or own a patent which allows it to capture the market share? So one example is AirAsia. It's able to change the process of flight booking. However, it is not able to sustain consistent earnings due to capital-intensive nature of its business and primary reliance on commodity for its business to function. So, although AirAsia changed the entire processing of the flight booking and so on, they changed the entire process. But then, why AirAsia is not considered a super growth company? Because how profitable the company is depends on oil. Yes. Because there was an incident, I think some years back, where AirAsia hedged wrongly, and then saw them suffering tens of millions of losses because they hedged wrongly. When you rely on that commodity so much for your business to function, then it becomes a problem. Okay, although you might be able to change the entire process. Okay, another one is myeg.com.my. Okay, it provides solution with recurring income stream that does not rely on commodity for its business to function. Its business model is also non-capital intensive. So if you want to start with a growth company, start with a company that is not capital intensive. Okay, start with a company that has solutions and steady income stream. Okay, not that that it relies on a lot of promotion to bring people. For example, AirAsia, it needs to do a lot of free seats and such to draw people to book the flight, to travel. Okay, but let's say a company like MyEG, okay, it provides solutions. Okay, you no need to offer discount for people to go because it's offering convenience. So just like why Amazon works, because it's offering convenience. Okay, but they are non-capital intensive. So for example, the marketplace for Amazon is they are the medium for third party to sell their goods. They just take a commission. They no need to produce the goods themselves.
Yeah, but the risk in the case of MyEG is that they are reliant on the government policy.
Yes.
So that's their greatest risk.
Yes. So because the risk for MyEG would then be because of the reliance on continuous contract. But I think not that I'm recommending MyEG or recommending AirAsia. You need to do your own evaluation. Okay, so much depends on whether MyEG would be able to move away from reliance on government. Okay, and to focus on expanding its own solution to other payment for other types of services. To diversify from its monopoly. Then that would be good for the company. Okay, but this is just showing MyEG because when looking back to MyEG, there are 5 years. Okay, even the 2018 versus 2014 revenue growth and net profit growth has been rather huge as well. We are looking at hundreds of percentage gain, but there's still weakness. Okay, so knowing these two companies we are sharing because we want you to know that how they change it, but also where the weakness lie. Okay, so diversification for MyEG and AirAsia is that reliance on commodity. Okay, so look out for consistent growth in several key metrics over a period of 3 to 5 years using the following benchmark. Now, revenue growth, looking at more than 15%. Anything that doesn't meet revenue growth 15%, I wouldn't think that it can move into the growth category. Net profit, but growth must be more than 20%.
Wow, more than 20% is a lot.
Yeah, because if you look at it, the going back to REITs as an example, okay, the net profit growth is 100%. So you average out over 5 years, okay, it is more than 20%. So right now, using that as a benchmark, okay, you look for net profit growth of more than 20%. Now, if let's say the company is still losing money, okay, but revenue growth meet, then what you need to do is that look back on this quarterly report to ensure that net loss is narrowing. Okay, then that would put you in greater confidence. Okay, equity growth must be positive. Now, equity growth, I wouldn't want to signify that it must always be double digit, but as long as it's positive, because sometimes company may use that to expand, okay, and that is shown in the revenue and net profit growth. Okay, so as long as it is growing, then it is a good sign. Okay, ROE of more than 15%. Okay, again using REITs as a benchmark. So if you are investing at the startup stage, it is important that the company has a strong balance sheet because there will be cash burn initially. Measure the financial ratios to determine the balance sheet strength. Okay, so you have to look at the current asset versus the current liabilities. Okay, debt to equity ratio to make sure that they are not that the company financial health is really in good condition. Okay, then the other thing is to have patience. So for example, you can see that kind of growth in REITs because it's happened over a 14-year period. Okay, not something that you need to see immediate satisfaction, 100% growth in 1 year or 2 years. But why REITs, the average per year is 300%? Because a lot of the growth happened towards the later part of the last few years, not at so much at the initial stage. Okay, so for those people who have patience, definitely they will see the fruits of their investment. So let's look at the next growth miracle. Okay, so we will diversify away from Malaysian stocks in this sense. Okay, so let's talk about the next growth miracle. Technology will play a leading role in all sectors of economies. AI, big data, robotics, nanotech, cloud, Internet of Things, quantum computing, and blockchain. So AI right now, for example, the world's first female AI news anchor, appeared on TV in China. Okay, then AI chip. AI stands for artificial intelligence. Okay, where Qualcomm's have their own AI chip for cloud, and NVIDIA also have their own artificial intelligence section, which are developing those chips as well. Yeah. So robotics, right now we see that robotics are entering to our home in terms of robotic vacuum cleaner as well as robotic mop. Okay, right now they are into our household doing the chores that normally a stay-at-home mom would do or a domestic helper would do. Then nanotech. Okay, Huawei's Kirin 980 is the world's first 7 nanometer mobile chipset with 5G support. Wow. Okay, so right now, things are growing smaller and smaller and more efficient. Okay, then Internet of Things. This is an example of the Xiaomi ecosystem. Okay, how they use the 5G or the internet connection to connect to multiple devices. Okay, then combining AI, big data, fintech, and nanotech in medicinal science to enhance efficiency across all sectors. Now, if you look at the bottom right-hand side, okay, that's this this company's Sino Biopharm is using nanotech delivery system to inject okay, the drugs into the body, okay, to make it more efficient in terms of recovery, okay. And then you can see that they are using big data for diagnosis, okay. They are using fintech to manage their business, okay. So everything right now is very, very connected. Wow, right? And this is China Communications Service. They are combining AI, big data, Internet of Things, cloud, and blockchain to scale up value-added service. Okay, you can see that the 3 stages that they are embarking upon. Okay, for example, they are providing services for industry, how to create a smart industry, how to create a smart ecosystem in a particular industry. They are even developing smart city, connecting all the surveillance system, or connecting all the data, okay, entry, so that they know which are the efficient route, okay, which are the which city need urgently to move the so-called resources to which sector of the city. Okay, so it's all using AI, big data, and Internet of Things, cloud, and blockchain. Yeah, so this is what I'm talking about, green tech. Okay, evolution and application of green tech across various spectrum of industry. For example, biomass, anaerobic and aerobic, geothermal, solar, wind, tide, and thorium. Now, thorium is something that is nuclear power, but the thorium is actually better than uranium, because thorium doesn't generate radioactivity. The reason why uranium is used for nuclear energy is because you can weaponize uranium. So it's like killing 2 birds with 1 stone. Okay, you can generate electricity and you can weaponize the uranium for nuclear warhead. Okay, but thorium is very different. Okay, it has very low radioactivity and you can't weaponize thorium. Okay, but this is something that China is going into. Okay, then for example, some companies in China, okay, they have this anaerobic so-called technology. Now, some of us, we stay in those housing estate. You have those percolating pond where all the sewage are pumped to the pond. Okay, then you have they have this pond which cause the reaction to break down the sewage. But in China, they enclose the entire sewage system so that the anaerobic activity takes place and generate gases which can then burn to generate electricity. Okay, so that's how it has changed, and also using geothermal to control the room the factory environment. For example, during summer, okay, geothermal technology would generate cool air, and then during winter will generate warm air. So all this would lead to less dependence on fossil fuel. So that's why the green technology is also one of the fastest growing in the world. Then another thing that you should take note is that by 2030, major economies such as the EU, China, and India could ban all combustion engine vehicles, pushing for the development of batteries, electric vehicles, and hybrid electric vehicles. Okay, so you can see that in this chart, okay, by 2040, electrical vehicles will actually constitute 35% of total vehicles. So that is tremendous growth. Okay, so that's why when it comes to this kind of technology, yes, electric vehicles could be something that you should look at. But right now, it's not the time. Okay, for example, what we see now is that major automobile industry is collapsing. Okay, because demand is falling.
Demand for cars
is falling. But surprisingly, demand for cars is falling. It actually affects a lot of those car stocks. But actually, even as demand for cars is falling, there is still some steady increase in terms of electric vehicles in some parts of the world. So that's why, right now, because you have those companies that is involved in the auto industry. Okay, let's say General Motors, they have both electric as well as combustion engine, ICE. But what is happening is that most of their products are actually ICE. So that's why when ICE demands fall, it actually impact the entire industry. That goes for the same for Volkswagen, okay, and BMW, Mercedes. They are seeing declining sales, okay. But it is something for you to take note of, okay, because in the future, this is what is going to happen. And right now it's not the time, because this timeline could be extended, okay, if government suddenly realize that it's not ready. So something to look forward, you know, will be somewhere around 2025. Okay, seems a long way, but that is something that you can put it, you know, in your notes, okay, that if you go into this industry, you can always ask yourself what's next, okay. So another thing is that biotech evolution in genome mapping and search for cure for multiple diseases. You know, application of genome research in agriculture and livestock farming.
What is genome?
Genome is actually the our DNA and such, okay, chromosomes. So China is also creating the world's largest cloning factory, okay. And
what do they want to clone?
Human organs for transplant.
Human organ. Oh, okay.
Okay, so this is, you know, because China got no religion, okay, to forbid them from cloning human tissues and so forth. Okay, that's why in a lot of Western countries, okay, there are certain religious group that is against human cloning of organs and so forth. But China, you know, is going away because the country have no official religion and so forth. Okay, so that's why China now has built the world's largest cloning factory. So, and that's helping the industry to grow even much bigger. Okay, so eventually maybe people wants to go for transplant may have to go to China. Okay, but this is happening. Okay, then the other thing is that metallurgy and rare earth industry is set to evolve as industrial and military needs spur new developments. Okay, may see new composite materials that open up new frontiers in manufacturing. For example, a type of composite material would be vanadium and steel, which improves the tensile strength of the steel. So vanadium combination with steel has now been imposed by China on all their steel specification, because it helped to improve the strength of the steel. Okay, then new alloy to improve stealth technology may push new frontiers in military spending. Okay, so what you are seeing there in the picture is actually the J-20 stealth fighter from China. Yeah, so some metallurgy usage, for example, they are combining magnesium into automobile construction, which actually strengthen or make the steel in the body of the vehicle last longer or stronger. Okay, so they are putting magnesium into it. Okay, so there's a lot of metallurgy right now doing, and recently I read not only metallurgy, even plastic. Yeah, US has discovered combining plastic with another type of chemical that make it as strong as body armor. Okay, and that's using a type of plastic. So, and it's lighter. So that's how things are actually changing in the materials industry. So this is also another growth, especially rare earth, because rare earth is something that's very new, and rare earth industry only really take off over the last 20 years or so, because the advent of smartphone actually consume rare earth because all of the magnets is used to vibrate the phone. Okay, so that's why, for example, China has come up with a rare earth industry plan to look into how to have a vertical integration of rare earth to spur new development of materials using rare earth. So this will be the next growth area as well. Okay, then online and virtual shopping will be enhanced through fast connectivity. China is expected to lead with the adoption of 5G. Other front runners are Finland, South Korea, and US. But China is already starting, so they are already in front. So the tagline for the future will be mobility plus connectivity. Okay, and this is something that is really very out of the world. Okay, that is space, the last frontier. Now it will be a new economic frontier. Okay, because China recently launched the world's first quantum satellite. Now the quantum satellite is said to be unhackable. Okay, and Trump has also called for the formation of a new space force. Construction giant Obayashi recently proposed a space elevator.
Is that a Japanese company?
Yes, it's one of Japan's largest construction company. So they propose a space elevator, for tourists, for tourists. Okay, intense competition to form the first moon and Mars colony. In fact, in the deserts of US and in the deserts of China, they actually have specific community that live as though they are staying in Mars. Okay, yeah, they are training the people. Okay, to in that sense. So the race would then be to in the space economy. Okay, and that would involve, okay, again, technology companies, telecommunication companies, okay, and material companies. Okay, so these are the things that would drive the space industry.
So you have shared with us like so many new growth sectors that we can look into. So how do we participate in this kind of growth?
Yeah, so that's how do you want to invest in the next growth miracle? Now, the new industrial evolution will take place outside of Malaysia. Okay, so among giants in their respective fields of expertise, and that is because we don't have that infrastructure actually, and also that sad to say, Malaysia also lack that kind of knowledge to expand in that sense.
Our Malaysian tech industry are mainly downstream to midstream, not in the upstream.
Yes, we also, but Malaysia can play a supportive role. It actually depends on where it will spill over. Okay,
hopefully we can get more subcontract.
Yeah, and also for example, let's say what we can look at is, for example, in the pharmaceutical, assuming certain pharmaceutical companies get a certain master licensee, okay, for a cancer drug, okay, and things like that, or the spillover of the let's say there is I will share one particular company. It has already spilled over to Malaysia, okay, and it benefit actually Penang. So I will share with you afterwards.
Yeah, but no worries, even though it takes place outside of Malaysia, but Kenanga Investment Bank always there. Cantrade is always there to help you to invest abroad.
Yes.
So if you have not had an account with Cantrade yet, you can find any of the dealer representative to sign up an account.
Yeah. So look out for companies, okay, tie up or being part of the supply chain in the new industrial revolution. Now, the other alternative is to invest directly in these leading companies. So foreign companies, that is worth a look. Now, the current economic slowdown, which can potentially morph into a full-blown recession, provides the ideal environment to invest into some global growth stocks. Okay, that doesn't mean that as soon as this webinar is over, you start doing your research and you already want to invest, because definitely the economy slowdown is very, very real, because global PMI is already in contraction. The world is printing even more money, supporting even huge and bigger debt, which will not push the economy better, but push the economy to become even more indebted, and those are not good signs. Okay, so some foreign companies worth a look, for example, is iRobot. Now, they are a global leader in household robotics. I show you a picture just now with 41% market share. Now, iRobot actually, in order to circumvent the trade war, okay, because their products are manufactured in China, they now have actually built a plant in Penang, okay, and they are going to ramp up production in the Penang plant to meet the global demand. Okay, but unfortunately, I think iRobot is not listed in Malaysia, but then it benefits Malaysia economy to a certain extent, okay, because the investment comes into Malaysia. Okay, so but if you want to participate, you can look at iRobot, okay, which is a US-based company. Then Qualcomm and NVIDIA, okay, both are major players in cloud and AI chips. And these two companies have seen their shares fallen quite dramatically because of the ban of sale to Huawei. Okay, but so far there's no strong confirmation that the approval has been given to them to continue selling to Huawei. Okay, so that remains to be seen. Okay, but you can actually look at these two companies as the share price goes down, to decide your entry point. Definitely these two are very huge, okay, in terms of cloud and AI chips. Then the other one is Xiaomi. Okay, it's ranked number 4 in global mobile phone sales and eating into Apple and Samsung share of the market. Now, what is happening is, although Samsung and Apple, they are number 1 or 3, okay, but their share of the market has actually fallen. Now, the share of Apple and Samsung have actually gone into Huawei and Xiaomi. Okay, and Xiaomi is something different because it has its own Internet of Things ecosystem, which will continue to drive the sales of its other appliances. Now, for example, Xiaomi is very popular in India. In fact, the introduction of Xiaomi have pushed away all the locally made India brands because they just want Xiaomi. And Xiaomi, the Mi TV is the #1 selling TV in India. Okay, so in that sense that Xiaomi, if you can, any companies that is able to go into a billion+ population market is tremendously good potential. Okay, and Xiaomi, since it's listing here, it started off at about 22 Hong Kong dollars. Its price now have dropped to about $8 to $9. I expect it to drop further because the semiconductor export is showing a decline. Okay, in export from South Korea. That means that mobile phone sales and electronic appliance sales are falling. So watch for a better entry, perhaps around 7 to 8. Then you can consider for Xiaomi. Okay. Then Sino Biopharm, I already shared just now, is one of China's leading pharmaceutical companies. China has fast aging population, and with it a demand for healthcare. The company owns many patents in the biotech sphere. So I think the last time I did a research on Sino Biopharm, they actually have, I think, 60+ patents, yeah, in their stable. Now where Chinese companies are concerned, they are the #2 in terms of number of patents filed recently. Okay, just behind the US. Yeah, and then there's also China Communications Construction. Okay, just now I shared the China Communications diagram, which combine 5G, AI, big data, cloud, IoT, and blockchain to upscale its delivery of services. Then in terms of green tech, now China is the world leader in terms of green tech energy. Okay, two of the companies that you can consider is like China Everbright Green Tech and Xinyi Solar. Xinyi Solar has Malaysia, also invested in Malaysia. They have Malaysia has one of the largest solar glass manufacturing in Malacca. Okay, and it's actually belongs to Xinyi Solar. Xinyi Solar, besides producing solar panels, okay, they also run about 10 to 11 solar farms in China, and they are really huge. So also they have steady income stream besides selling solar panels. Now China Everbright Green Tech is a bit of a risky player because their operating cash flow has always been negative. So what's the difference? Why is it always negative? Now China Everbright Green Tech, they have a lot of contracts with governments. In fact, that they have 100 over projects that is in the green energy sector. So what they do is that a lot of it is built first, then operate later. So that's why China Everbright always have consistently negative cash flow, operating cash flow, because once they have to spend money first, and when that project is done, okay, then they start earning. So what we see in China Everbright Green Tech is that negative cash flow from operating activities, but profit keeps on increasing because more and more projects went on stream, they earn money. Okay, but then likewise they build some more because they have those 100 over projects to meet, deadline to meet. Okay, but the interesting thing is the equity keeps on moving up because once the project is completed, then then there is asset value in that project. So, but if you are the one that is, you want to look at positive cash flow, then China Everbright Green Tech may not be the one that you want to look at. Okay, rather I think Xinyi Solar is a much better company because they have streaming income through solar farms, as well as they are one of the world's largest producer of solar panels. Yeah, so final disclaimer, number of potential good companies to invest in are inexhaustible. The examples shown here are not a recommendation to buy. It is prudent that you do your own due diligence and analyze the company's financial reports before investing. Okay. So that comes to the
All right, so now
session.
we are at the question and answer session. So if you have any questions, you can ask PC. We will do as quick as possible because we overshoot the time for a little bit. So now the first question I have on my screen, PC, is how are you informed or told about a growth stock? Do you follow a stock for a number of years before you enter the market?
Okay, now one of the key things that you investing always adopt a top-down approach. Why do I say top-down approach? Now, for example, why I come up with some of those that is in the, for example, I show a number of Chinese company. Now, what came up was the news that China has this Made in China 2025 and the 15th China plan. So which detailed what they want to do, for example, quality in environment. Okay, so when you see that they want to have quality in the environment, then the next thing you want to look is what are the green tech companies in China. Always have a top-down thing. So Made in China, where they detail that one of the industry is semicon, okay, then the other one is biotech. So this is when you realize that these are the industry. Then another example is when I come across Belt and Road Initiative. Then if you are an investor that's well attuned to the needs of the Belt and Road, you will know that what will it entail? Infrastructure. What does infrastructure need? Steel, okay, and cement. So that's what happened is that I will look into steel companies in China, that's cement companies in China, to see that, so that they will definitely be the beneficiaries of the Belt and Road. So you adopt a top down. So just like so much talk about AI. So what are the companies that will benefit from the evolution of AI? So that's why you look at AI chips. Okay. So when I look at robots, for example, robotics is actually gaining popularity. So then you do a search. Okay, for example, I know that robotics and AI is going to be important, so I just type in, robotics company listed in US. You have a list. Then you check each company to see which company is really have the market share and also which company is profitable. So these are the things that you can do. Okay, don't just plug a company and you start following. Okay, you must know the reason why you want to select that company. It must always be a top-down approach. Like I share with you. Okay, like let's say just now oil palm. We talk about oil palm. It's a mature market. So what entry into a market that will change that particular company? So the other thing is to look at, will a biomass company be successful, because there's so much palm waste in Malaysia. Then you look whether there's type into go into Google and type biomass company listed in Malaysia, see what it yields. Then you check if let's say there are some companies, then you check which companies are. Okay, so for example, I know that military, China is building out its military. US is spending even more money on its military, stealth technology and all that. What does it require? Rare earth. Then there's news that China may want to impose restriction of rare earth to US. So which are the rare earth companies in China that will benefit from this rare earth restriction? So you do look rare earth company listed in China. Then you have a list, and then you do your own analysis to see whether they meet the growth criteria. They have that kind of steady balance sheet. So that's how you go about doing your selection.
Okay. Now the next question we have is, after we invest in the growth stock, how do we know when to sell?
That depends on the individual, your price target. Okay. Now, as what I often like to do is, when I already invested, I would like to check on its quarterly earnings every time it comes out to see whether the growth trajectory is intact or not. If let's say the growth trajectory is intact, then I will hold a bit more. Now, so much so that if let's say sometimes we try not to be too greedy, okay? Then assuming you put in shares, put in 5K into that particular stock. So in the next 5 years, bonus issue and all those, okay, your holding right now becomes 10K. So do you want to exit everything? Or you might want to say that I want to sell the 5K first so that I at least recover my capital. Then the remaining 5K, I see where it takes me. So you must have certain strategy in that sense. Yeah.
Okay. Now the next question: usually, how long can a company remain as a growth stock? For example, after a company has been growing for the past 5 years, can it still be classified as a growth stock?
I think one good example is Microsoft has been around for so many decades. Okay, it's still a growth stock in a sense that its profit and all those meet the criteria of a growth stock because it's strong double digit. Okay, but at some point in time it will reach a maturity where the market is either it's not willing to pay that price for that particular stock, or the growth no longer interests the investors. So always have an exit plan, okay, and you will know your exit plan by, again, back to the quarterly earnings. Okay, you cannot just say that I buy into this growth company, I want to exit over the next 10 years. But if let's say its performance starts stagnating or start going down, then you have to quickly change your strategy and maybe sell off your entire holding.
Okay. Let's do one more question. Is PC, what do you think of the potential growth of the Malaysian renewable energy or green tech sector?
I think Malaysia has a lot of potential in that sense. Okay, even if you talk about solar energy, Malaysia is a tropical country. Okay, there's tremendous opportunity to latch onto our on our environment. Okay, then the other thing is Malaysia has an awful lot of waste that we are, is seen in our pollution. Okay, sometimes you see rubbish thrown everywhere. So that is the thing. Is if let's say Malaysia have the right frame of mind, a good government incentive to go into it, then I think the green tech industry in Malaysia could actually develop and maybe export that kind of expertise. So sometimes I think don't downplay the opportunity, because it's like REITs, they started off with simple equipment, and then it goes on into more better equipment, with even more different type of equipment. So it slowly grows that market. So it's just like, if let's say certain technology is workable, okay, assuming let's say biomass, I think biomass, where oil palm plantation is concerned, okay, agriculture-based companies agriculture-based economies are concerned, then it will be a very big opportunity. Yeah.
Okay. Let's do one last question, but keep the answer more brief. Yeah, PC man, there are a lot of market analysis that saying that next year the market will boom. But just now, based on your opinion, you say that it will be slowed down. So what is your rationale?
Now, a lot of people are expecting the market will boom because they expect the Federal Reserve to print even more money. Okay, but the more money it prints, it means that there's more debt. And right now, the whole global economy is facing a debt saturation, which means no matter how much debt you put in, the economy will just not grow. Okay, that's my rationale.
All right, well, you really keep it really brief. Now, all right, so this is our next Cantrip webinar. Now, as I mentioned earlier, Kenanga has already designed a few webinar in this 2019 series for you, because they want to help investors like you to make wise and informed decisions. So the first was today, which is how to invest in growth stock. The next webinar, which will be happening on 21st of November 2019, which is a Tuesday, which is a Thursday, is valuation masterclass. So you've always wonder, how do I value a stock? Should I use intrinsic value? How do I calculate intrinsic value? Should I use PE ratio? Should I use price to book ratio? Or should I use dividend yield to evaluate the stocks? So now stay tuned and register for our next Kenanga Cantrip webinar, which is happening on 21st November, 8:30 to probably about 10 o'clock. So for those, if you really have something to do on that day, don't worry, you can still register first, because we will still send you recordings if you miss the webinar. And alternatively, you can stay tuned on Cantrip's website, because they will publish this webinar on the Kenanga Cantrip's website. So that's how we can support you. And the registration link for the next webinar, Valuation Masterclass, is already shared in our webinar chat group. Okay, you can go to the chat group and quickly register for your spot right now. And based on today's webinars, we assume that it will also be overwhelming response. So the earlier you subscribe, the earlier you just register, the better it is. Okay, with that, I want to thank PC
Okay, you're most welcome
for
Shane.
sharing your idea how we invest in growth stock despite high valuation, and how should we hold for it and when should we sell it. Thanks for sharing your idea about how do we invest in growth stock, but not only participate in Malaysian growth, but also look at the growth abroad, because sometimes growth happening in outside of Malaysia, beyond the Malaysian boundary, is faster, than what happens internally in Malaysia. And this webinar is brought to you by Cantrade, by Kenanga, also supported by LifeChamp, which we helped to put this together. With that, this is Shane Choo signing off from Cantrade webinar. See you guys again next month.
Okay, goodbye.
Goodbye.